Folks, welcome to the latest episode of the Street Stocks and Markets podcast. I'm Chris Versace, the portfolio manager of TheStreet Pro portfolio. Joining me this week to tackle what's driving the markets, discuss what's confounding investors, and help you move forward as we navigate tariffs, trade deals, and the March quarter earnings season is Bob Byrne. Bob is a Street Pro contributor, and in his writings, he brings his experience as a long-term and short-term swing trader to members. Bob, thanks for joining me today.
Chris, it's great to be here.
Now, Bob, you have been a Street contributor for a long time, just like myself. But, what we're trying to do here is really kind of set the table for the conversation that we're going to have. To do so, just give us a thumbnail sketch of your background, how you trade, how you invest.
Yeah, so I began as basically a day trader. First part of my career, 20 years, was day trading equities and futures. Began in the late 90s, 97, 98. Dialed back my day trading portion around 2018. So today I will still do short-term trading, but it's definitely around volatility. But I also manage a long-term book and a lot of private investments.
Okay, so just out of curiosity, you said that you kind of put day trading to the side a few years ago. Was there something in the market that led to that?
Yeah, no, that's a great question. On the equity side of day trading, everything changed. If you guys remember when they adopted hybrid in 2007, right? When they took the NYSE and they really tried to make it electronic, get rid of the specialists. That completely changed because prior to that, it was me versus you. It was me versus another human. And so it was a lot more psychology. It was a lot easier, to be honest.
Bob, why do I sense a Terminator reference coming?
I wasn't competing against Hal the supercomputer. And that's what it became after 07. So around 07, 08, me, like a lot of day traders, active day traders, we did shift from individual equities more toward ETFs or futures.
Okay. All right. So today, you just mentioned that you do manage a long book. So kind of what's your strategy, your style for managing that?
So longer term investments for me kind of fall into two buckets. I think a little dirty secret among active traders is they actually are hidden value investors. It's a lot easier to value something off of cash flow, free cash flow yield, even simple things like dividend yields. But I don't look at a dividend yield and say, I want to own the stock. I'm going to look at a free cash flow yield, dividend, payout ratios, all these things, but I'm going to chart them. So where is the dividend yield in relation to where it typically is?
Right.
So I am looking for something that I believe is a value, has sold off. Maybe the fundamentals are bruised but not broken. Okay. And so I'm looking for something that is paying out more than it ordinarily would over a 10 plus year horizon.
So you're kind of looking for compressed valuations. I mean, that's really what you're saying, right? I mean, it's funny that you mentioned that because typically before I, begin a new position, I will look back historically at a variety of multiples, PEs, PEGs, EV to revenue, EV to EBITDA, but also too, as you pointed out, for dividend payers, dividend yields. And that's really why, or I shouldn't say why, but it is another reason why I really do prefer companies that not only pay dividends, but they have a rising dividend bent because it's just another tool.
Totally agree. One of the examples I like to give, and it's a while back, but back in 2012, the free cash flow yield on stocks like Microsoft, Intel, Cisco.
Yeah.
They were off the charts. No one wanted these things. And it doesn't happen very often. You can't think you're going to sit down every day and say, I'm going to go find those great payers today, but you're looking for them. They do happen. They do appear.
Okay. So that's kind of some of the financial metrics that you look at. Mm-hmm. I guess my next question would be, are there any others? And then just stepping back, when you look at companies, sectors, what have you, are there particular characteristics or business models that you look at or look for?
Yeah. So I mentioned kind of two buckets there, the value dividend, but I also like out of favor growth, out of favor technology. But when I say out of favor, it's kind of the wrong way to put it. Take today's market in particular. Everything fell apart together in unison. It didn't matter how well your business was doing 2-3 months ago. You basically got sold, unless you're maybe McDonald's or something. Okay.
We'll see. We'll see about that.
But I want to look at companies that reported really good earnings in the couple quarters prior to this kind of downdraft,
Hmm.
and then figure out, is there something, should that change dramatically into the next quarter? One example, I'm not long it now, but I'm actively watching, is Snowflake. Snowflake was completely out of favor after it came public, had a ridiculous valuation, really ludicrous. But in the two most recent quarters, they completely surprised everybody because they pivoted entirely toward AI. And
Hmm.
based on their customer metrics, they're doing really well at it. And after both earnings releases, the stock exploded. So
So
stuff like that.
I'm, I'm going to toss one to you just to get your reaction because I felt like ServiceNow was the exact same thing.
So ironically enough, I was on a panel about 9 months ago, and ServiceNow was one of my picks. I was blown away by how poorly it was getting hammered. I was not surprised by how well it did after earnings.
Yeah, totally agree. Totally agree. All right. So with those two buckets, and you mentioned a couple names just now, Snowflake, are there any other companies that you're kind of warming up to, just given what we've seen over the last few months? And it appears that as we go through earnings, that so far maybe they're a little better than expected, or shall we say, not as bad as feared.
I don't think I think earnings are going to be fine this quarter. I mean, earnings as a
Well,
whole.
okay, hang on, hang on. Let's bifurcate this, right? So there's the March quarter earnings, and then
Correct.
there's the June quarter guidance. Which one are you more concerned about?
Oh, well, June and forward. So next
So
couple
second half of
quarters,
the year.
yeah, second half of the year, I think is going to be scary.
Okay. Why? Now I've talked about this quite a bit, and I'm curious, for what your reasons are.
I mean, I think the most obvious is when you don't know what to expect, the smart move is to typically do very little.
Right.
And I
Right.
think that's where a lot of companies are. I mean, look, you don't just up and move a manufacturing plant. You don't up and make multi-billion-dollar allocations around the globe on a whim. You really do have to have some certainty. Um, I think it's a little bit silly to expect companies to up and move all their manufacturing in very, very short order. It
So
takes a while.
so short order, that's an interesting point because I'm having conversations with folks, and they're like, 1 year, 2 year, 3 years, you can't build
No,
a world class auto facility in that short a period of time. You know, there's just a lot of, I guess, questions over what we're hearing and whether or not how viable it is over the long term.
yeah. Best example I can give is there's a small company that I was working with recently, it's a semiconductor company and a scientific materials. Took these guys 6 months just to get a small little bench test up and running.
Yeah.
And these guys had proper funding, brilliant people behind them. You want to talk about building a fab or building an auto manufacturing plant or any of these things, they're not fast. They're doable, but they're not fast.
Then they're way more complicated than I think, let's just say, building an office building is for frame of reference of
100%.
certain folks in Washington that, are great developers.
I want to go back. You asked for a couple stocks that I was looking at now, and
Yeah.
I haven't done anything with them, but I am looking at them. Uh, Nike and Target. Both those companies have been killed, obviously, because of tariffs. China in particular. Nike has their own issues outside of tariffs. Um, there's been a couple hedge funds that are accumulating Nike quite a bit. Part of me thinks there might be something done there on the activist side. More than anything, if you look at Nike, it's basically, for example, being priced as though they're never going to make any money again.
Correct.
Now, I don't want to own something that's just going from the upper left to lower right, but I want to find something that is interesting to me, might have an interesting thesis, and then I'm going to start looking for a reason to buy it. I don't
Mhm.
fundamentals alone are never going to get me into a position, right? I born and bred a technical trader, so I want a reason to want to own something, and then I need a reason to actually act on it.
What about a reason not to own something?
Oh, I've got lots of reasons not to.
So walk me through the Bob Byrne litmus test, right? So there's a lot of folks out there, and PMs especially, where they're going to run a book of 20, 30, maybe is 40 names. But the number of stocks that they look at, the number of stocks that they get pitched by sell siders, far greater than that. So they're always looking for reasons to say no.
Mhm.
So what are some of the Bob Byrne reasons to say no?
On a technical standpoint, I am a very, very basic trader. I don't use a bunch of indicators. Um, Helene Meisler, one of my favorite people to read.
She's the best.
Her
She's the
stuff is
best.
it, look. It doesn't have to be complicated. I mean, higher highs, higher lows. If you insist on a couple indicators, a couple moving averages. If you're a short-term trader, something like a 5 or 8 period simple moving average and a 20 or 21 day, whichever. People go either way. They're the same. You are not going to get very different results with those. You're a longer term investor. Kind of, I can't even remember who first told me this, but good things tend to happen above a 200-day moving average, and bad things tend to happen under it. It's a really simple way to look at things. I'm not saying you got to bail on everything under a 200-day moving average, and I'm not saying buy it above it. Okay, but it's a very good litmus test to begin with.
Agreed. I feel like I'm channeling our mutual friend Bob Lang for a second. But so let me ask you this though. So in the current market environment, right? Tariff uncertainty, questions about trade deals. We're kind of migrating through the earnings season, and like you said, you think that the March quarter will be okay. June quarter guidance is the question. I agree with that. But the market that we're in, we're off our April lows. We're kind of careening with the S&P 500 towards the 50-day moving average. Could have resistance ahead. How are you navigating the market, near term?
So from a short-term trading standpoint, if there's not a lot of volatility, I'm not trading it for a couple reasons. One, in my kind of 20 years of day trading, there were two groups of people. There were the people that traded in the first 2 hours and maybe the last 90 minutes of the day. They typically made money. Then there were the people that traded all day, every day. Okay, right over lunch when you had a lot of random chop. Random chop, it's random. You're going to make mistakes. You're going to see patterns where patterns don't exist. I think that's where we are right now in the market as well. When it compresses back down, there's not a lot of sense to most strategies. If you have a strategy that works in it and you can see it in your own results, great. Most people need volatility and price moves. I need it. So right now, when the volatility comes back, which I think it will, I think volatility is going to be back in another week or two.
100%. Now, why that time frame?
We've rebounded sharply. I don't know if we're in a bear market, but we're certainly in a bear pulse, if you will. What's been settled? Like what?
There's no clarity. There's no clarity.
None. Everything that sent us lower, it's still there. It's just that the bond market and maybe the equities, but the bond market scared, the president and the administration, whether they want to discuss it or not. And they had to pull back and say, okay, maybe we need to not rip the Band-Aid quite so hard. So
right.
Nothing has changed.
Well, it's interesting because, the conversations that you hear in these, at least this week, the 100-day briefings that we're getting at 8:30 in the morning, there are questions around, is there potential progress with, India, Japan, Korea? Japan and Korea have elections that are coming up, so that we may not see anything on that front until, July, right? No. China is obviously going to take their time. My understanding is that they are talking about the bully in Washington and how they are warning people not to appease him. So it tells me that there's going to be a slow road to this. And on the, the topic of tax reform, there's conflicting stories there too. The administration wants July 4th, but if you look at different comments, it's likely to be later than that, and then deregulation later in the year. So, if I'm gaming out the current quarter, I don't really expect all that much.
No, not at all. I mean, going to the tariffs in particular, it seemed like from kind of I won't say the very beginning, but right around that whole 90-day pause time frame, the administration wants to put China in a box. Okay. When you look at all the other countries and their tariffs, and we're negotiating tariffs, but at the same time we want manufacturing back in the States, which is
right.
I don't think anybody knows, because if I have a business and you're going to put a 50% tariff or whatever it is on me, well, maybe I might think about moving manufacturing. But if it's down at 5%, 2%, 10%, or 0,
right.
Why would I move? So we don't even know what the actual goal is, except to isolate China. So maybe the ultimate agreement is tariffs go somewhere near 0 or approaching 0, as long as those other countries also agree to put China in a box. And if they do that, that still makes things very, very complicated.
Agreed. 100%. All right. We're going to have to wait and see how all this plays out. But I wanted to ask you a different question, Bob. I I think for folks, it's really easy to deal with stocks that are doing well for them. But in a challenging market, how do you handle, I guess the only way to call it is a call gone wrong?
So I think it comes down to two things, whether it's a short-term trading call, which I think are easy. You know you're wrong. If you buy something without knowing where you're wrong and where you're out, you shouldn't have bought it in the first place. And I think that kind of realization comes from getting stung a whole bunch of times when you start out as a trader. When I started, I was in college and I had a string of probably 8, 9 months where I was doing great. I thought I knew everything. It turned out
Right.
I didn't know anything and ended up losing half my account in virtually one trade. I have never made that mistake again. And that
So,
was
so it sounds like discipline is what I'm hearing.
discipline is 100% it. It's all risk management. What's the saying? A chip and a seat or something like that. As long as you have a chip and a seat at the table, you're still in the game. Don't ever make a bet that pushes you out of the game, both from a monetary standpoint and a psychological standpoint. How do you react to things? So, like for me personally, I feel far more pain when I lose than pleasure when I win.
Of
So
course.
it helps me avoid a lot of situations. I don't miss out on opportunities. So if I can't identify precisely where I believe I am wrong based on why I'm getting in, I don't take the trade.
So, wait, say that again. Say that again.
Before I enter a trade, I
Hmm.
have to know where I'm wrong, or at least where I think I'm wrong.
Okay.
If I
What?
look at a chart,
So, what could go wrong?
yes, if I look at a chart and say, I'm not entirely sure if it's this point, this point, this point, or this point where I should be getting out, my thesis is off. The trade is too complicated. Don't make it harder than it has to be. And at the end of the day, sell first, ask questions later. If you're not sure, sell.
Okay. What about with your longer term portfolio when you're trying to build a position, right? You may not be as anxious to rip the band-aid, to use, the language that some like to use. You might say, okay, let's retest the thesis. Where can I, bring down my cost basis? But at what point do you go, "Ah, you know what? I got to throw in the towel. I need to revisit, need to let it cool off."
I mean, if it's a real long-term position and I'm invested in understanding the management, the operations, everything about it, you do ultimately you got to do two things. One, for me, I have to be willing to trade around the position, especially if it's something volatile. Uh,
Hmm.
if you're in a small cap position, you shouldn't be trading small caps or investing in small caps if you can't handle 30, 40% oscillations. It's part of the game. Okay. Um, did price move because of volatility or did price move because bad earnings? And if they're bad earnings, why were they bad? Is it a slight dislocation or did they take horrible financing indicating that they really don't have a capital market strategy?
Right.
So if it's a long-term position, you do have to ask deeper questions of why is the volatility there? And if the volatility is there because it has a high beta, then you just have to be willing to navigate that.
Right. Okay. It sounds like you're kind of touching on something that you didn't say but can be inferred, which is you really need to check your emotions at the door.
You can't have it's pretty easy. Like when you meet someone never traded before, they're interested in your past, you tell them what you did, you could probably figure out relatively quickly if they have the personality to be a trader, if they kind of wear their emotions on their sleeve and are kind of a little bit up and down, they're going to
Hmm.
struggle. I had some good friends, back in early 2000s that were traders that were kind of more emotional people, and they would do well for a while. But once you have a downdraft, they get killed. They would just
And
get killed.
yeah, I could see that because what happens then too is you have that big downdraft, and then you have to get more aggressive. You have to double, triple down, and almost instead of going for that base hit or stand up double, you're swinging for the fences.
Yeah, look, as a trader, your job is to take losses. That's what your job really is. It's to identify when something's not working and get out. You can always get back in. I mean, remember, unless you're moving, in some cases, billions of dollars, it's the greatest ability of the individual investor or traders that you can get in and out in a split second
Right.
with nothing. It's great. It's your advantage. In large part, it's your edge over the larger players.
So, with that being said, are
Mhm.
there any other pearls of wisdom that you would share with short term traders?
So this is probably one you won't find in a book, but you asked about kind of risk management.
Yeah.
Figure out how your body responds in moments of stress. So for me, it was my
Your,
lower back,
your physical body.
your physical body. So this is going back again. When I was in college, I noticed that it wasn't the dollar figure of a loss that impacted me. It was how internally I was reacting to a gain or a loss of any amount. And for me, it was my lower back. My lower back would start to really tense up and seize when I knew I was getting too emotional about anything.
Oh,
It could
interesting.
be $100 loss or a $10,000 loss. It did not matter. There were points where I would make or lose a lot of money, and I would have zero feeling about it, and that would tell me to keep going. Don't get up from
Hmm.
the
Hmm.
computer. There were other times where I could take a loss that was trivial, or or have a win that really was trivial, but I felt the excitement. My lower back might seize up on a loss, and I had to get up and walk away for a little bit because for whatever reason, I was not grounded.
Um, did we try yoga, a foam roller, anything like that?
I found a weight room. Yoga never did it for me.
Well, it works for some. I dabbled in Pilates, but that's a whole other story that we don't need to talk about. All right, let's segue, Bob, into some member questions. And remember, listeners, if you want your question asked and answered on the podcast, you have to be a Street Pro member. So, Bob, we got a handful of questions. Let's just rip right through them. Number one, Bob, what is the latest on your stock pick of the year for 2025? DeFi Technologies, ticker symbol DEFTF.
Yeah, so DeFi, it trades in Canada and on the OTC. You gave the OTC symbol. It's a financial technology company that basically connects your traditional finance with cryptocurrency markets.
Okay.
Um, I was attracted to it for one really basic reason. I am a old school equity trader. I'm not a cryptocurrency trader. I've never been a big Bitcoin, Ethereum type of fella. But there was enough there that I wanted exposure, but I wanted it in a form that I was comfortable with, and that's DeFi.
Yeah.
So it offers kind of that accessible crypto investment product for an investor like me or a trader like me. Um, Two things got me excited about these guys. One, they're making money, a lot of money. So it's basically an asset manager. I almost want to call it a State Street or a BlackRock for cryptocurrency. I like that. It was easy for me to understand. They're not just necessarily buying cryptos and seeing what happens. It made sense. Their revenue, I want to say they're managing over $1 billion now. Um, Market cap's around $1 billion and it's on the OTC. Why is it there? Because Gary Gensler did not like cryptocurrency when he was running
Right.
the SEC. Well, he
Do
is
you
out now.
right? Do you see that changing? Do you think they might list in
100%.
the U.S.? Okay.
100%. Um, I don't have any information that's not out there. All I can tell you is they filed their 40F, which is what a foreign company has to do to be uplisted to a senior U.S. exchange. Now that Gary Gensler is out, yes, I expect this to be uplisted soon. I hold a position in it. My main thesis here is it gets re-rated financially once it is on a senior exchange. Remember, there's a lot of people and institutions that either can't or won't buy OTC symbols, OTC
Right.
stocks. So
Yeah.
help the
100%.
company.
All right. Let's and you'll keep pro members updated on this, right? In your alerts.
I will.
Excellent. Excellent. All right. Let's get a second question. This question is a little surprising, extremely timely though, and it's on a topic that I think combines a couple different things. So here we go. Bob, what is your take on Amazon's plan to to provide a line item for tariff charges in the Amazon shopping cart? Kind of speaks to transparency, tariffs. What do you think?
As a consumer, I love it. You break out your taxes, you break out your shipping. Well, tariffs just another expense. Whether you agree with kind of the administration's approach or not doesn't matter. It is part of what I'm paying. I would like to know if I'm going to buy a widget for $20. I would like
Hmm.
to know if that the real cost of that widget is $10, and I'm paying another 10 because it's made in China or pick your country. So I think
Yeah,
it's great from a consumer standpoint. From a company standpoint, look, I think Amazon is trying to also tell their customers, hey, it's not us.
it's not us, right? Right.
Don't blame us when, whether it's they want to keep their margins up. They can't slash prices or any of this stuff. Okay, so it makes complete sense. The administration, of course, the administration hates it. They're still hoping that you believe that someone on the other side of the world is going to pay that tariff.
Right.
So of course,
Right. Right, right. Yeah, I believe the White House press secretary had some very nasty things, to use Donald Trump's language, about that news item.
Yeah, she was not pleased about it at all. Look, it is my opinion, is a good move for consumers, and it's a great move for Amazon. It makes total sense.
Do you think others, you mentioned Target earlier, do you think others will follow suit?
Online, yes, it's easier.
Too many stickers in the store to change
Yeah,
by?
when you're looking at bricks and mortar, will they? If it sticks, sure. Like if we really get to the point where everyone else around the world is paying that kind of 10% global tariff, and it all boils down to keeping China in a box, and it's all around them, yeah, I could absolutely see it. But it's just like anything else. A company's not going to want to make that change as a bricks and mortar unless they think the tariff's here to stay.
Well, did you hear what's happening in Canada with retailers?
No,
They're putting little U.S. flag like stickers on U.S. products where the pricing is, so they can tell people, hey, this is from the United States, and all the Canadian and other products are selling. The U.S. goods are stockpiling.
I mean, look, if you can find an alternative, most people are price sensitive. I mean, you're going to have some group that says I want to buy, American made only. You've
Hmm.
got a much larger group that's saying, well, this thing that I wanted is $20, but this thing that really does the same thing for me is 12 or 14. I'll just buy that. I mean, it is kind of basic economics. I don't think it has to be overly political or anything else. It's just basic economics.
I agree, but I will say that the chocolate in Canada much better. Just saying, just saying. All right, last question. And this one is going to be a little different. It actually touches too, Bob, on something that you wrote a little while ago and shared your thoughts on with pro members. So, currently, the IPO market is once again appearing to be in a pause. But why do you think, Bob, the Newsmax IPO was successful while CoreWeave struggled? And since then, we've seen Klarna, StubHub kind of pause, pull their IPO transactions. What was so special about Newsmax,
This,
other than the obvious?
yeah, look, this one is super interesting because in order to really understand this, you have to get completely off of Wall Street. This has never been discussed on Bloomberg, CNBC, pick your media outlet of traditional Wall Street. This has never been out there.
All right, break it, Bob. Break it down.
CoreWeave. CoreWeave was your traditional IPO brought by traditional Wall Street banks. Money was raised from accredited investors, venture capitalists, your 506Cs, all of that. Newsmax did it very, very differently. Okay. Newsmax, well, they did raise their money initially with a 506. Okay.
Mhm.
Then they switched into what's called a Reg A plus.
Now,
Now,
hang on. For the average listener, 506 is what?
506C is a company wants to raise $10 million. They're going to call their banker. They're going to put out a document. That document is going to, first and foremost, insist that you're an accredited investor, which means you make a certain amount of money or you have a certain net worth. They use those metrics to basically insist that you know what's going on, whether you agree with that or not. Okay. There's another avenue to raise money called Reg A plus or crowdfunding, Reg CF.
Mm-hmm.
Anybody can invest in these. It does not matter what your income is or your net worth because you can typically invest a few $100, whatever it is. I operate in that world in Reg A plus and Reg CF. I work with a lot of companies that are trying to go that route to explain it because it's different. Okay. That is what Newsmax did. Okay. So this is the first part of why Newsmax was successful. They raised a lot of money with a 506C. Then they did a Reg A plus to IPO. Their mechanism to IPO was not a traditional S1. It was a Reg A plus. If
Okay.
you got the email, you could invest at $10. Now, what did they do? They sent that to the Newsmax viewers.
Okay. So, in other words, they tapped their own list, is what you're
They
saying.
tapped their own list, but they also did it with a small firm, digital offering, that specializes in these. They know them well. I know the digital offering guys well. Well, I am not a loyal Newsmax viewer. I don't watch much TV. I knew of the offering. Okay. That made a big difference. The second part, and this is the most important one, when CoreWeave came public, it came public with a lot of shares,
Yeah.
and it was fully valued. You got to understand, Silicon Valley or Sand Hill Road, your traditional venture capitalists, your traditional early investors, they're not going to bring a company public until it's pretty well fully valued. This is not 1998 where you got the Yahoos and those type of companies coming out in the nine figures. In today's world, most IPOs don't come out until they're fully valued. This is why I think you are going to see a complete move away from 506C to Reg A Plus and Reg CF. It allows the IPO market to flourish again. So when Newsmax came out, there were only a few million shares in the public float. When CoreWeave came out, there were millions upon millions. It was a lot easier for Newsmax to move with strong demand than CoreWeave.
So are you thinking that if we see the IPO market kind of reopen, right, we get some certainty in the markets, are you looking for a larger wave of small, mid-size IPOs?
Led by smaller investment banks that, frankly, most people never would have heard from or heard of. And it's because people are realizing that it's not that the IPO market should be dead or is dead. It's that the old way of bringing things public, that is what needs to die. Okay, when you bring an IPO public today, and very often they're in the billions upon billions, and they've had, the names of all the venture capitalists. We've all heard them, the Sequoia Partners, all the rest of them. Those guys were in these things when they were initially raising at 20 million bucks. And then they bring them out at 20 billion, 40 billion. They bring them out as their liquidity events for those early investors.
Correct.
The Reg A Plus, the Reg CF, okay, those are the ones that are going to be coming public more toward the 100 million valuation, 200, 400 million, when there is a ton of growth left in them. Again, most people have not even heard of these avenues of investing. They are just really catching hold. A Reg A Plus can raise 75 million. A Reg CF can raise 5 million. There are stocks that the administration is going to raise those levels dramatically.
So, Bob, you're steeped in this world. For pro members or other people listening to the podcast that want to become a little more familiar with this, maybe even see some of these deals that are transpiring, what are one or two helpful resources?
If you want to just read, basically, you can Google Reg A Plus to get a feel for what they are. I do write about these on a website. It's a subscription model. It's asymmetricpublishing.com. Maybe I'll start bringing some of these to TheStreet Pro and seeing what people think of them there. There's a lot of offerings that are coming out there. Again, Newsmax showed everybody that there's a way for the IPO market to, frankly, work. Stocks pulled back dramatically, but come on, it priced at 10. It was supposed to open at 14. I can tell you that our venture fund sold well before it saw $200+. But it's still a double, and that's a lot better than most IPOs these days.
Yeah, true. All right. Anything to watch on that particular deal, Bob, or are you just kind of moving on?
Look, on Newsmax, at the end of the day, it is going to come back to valuation. Newsmax has a ton of revenue, but they're also losing a lot of money for their growth. They have to keep a handle on that. With Newsmax, obviously, it had a very, very loyal audience and a very loyal shareholder base. Mm-hmm. If I go back to simple price, when Newsmax came public, it priced at 10. It indicated at 14. It printed, golly, I don't even know if it printed more than a few shares at 14 before it was already halted and reopened at 22. If I'm looking at a chart of Newsmax, just because I remember the IPO day, as this thing loses $20, if you're trading it, I wouldn't want to be long. And if it breaks 14, not 10, but 14, I don't want to be in it at all.
Okay. Good to know. All right, Bob, you've been generous with your time, but before we get out of here, any parting words to the listeners as we get ready from earnings, a big week of earnings, Apple, Microsoft, Amazon, Meta?
It's funny. I was looking at these things earlier. I guess I'm one of those people that has never, for the life of me, understood Apple. I try not to opine on it because I have been so wrong. I have thought Apple should be significantly lower for ages. Mm-hmm. It doesn't have the growth. It just doesn't make a lot of sense to me. Now, if you go to Meta it's a great company, makes a ton of money. I'm a little nervous about their advertising for the rest of the year. Again, like all these companies, I think their numbers are going to be fine for the last quarter.
So hang on. So when you say their advertising, you're talking about their advertising revenue stream against the back of a slowing economy and companies cutting back their spending?
Yes.
Okay.
Yes. I think they're going to be conservative, and I think it's going to be, I don't want to say red wrong, but I think the stock could take a hit. Amazon, I think there's going to be a lot of questions around Amazon's tariff decision today to list the tariffs on the call.
Mm-hmm.
There's obviously going to be a lot of political pressure put on them going into it. I think all the Mag 7 numbers are going to be generally okay. I think their guidance is going to be less than impressive to concerning across the board. Again, I don't think, when you look at the market where it is now and how it's rebounded over the last X number of days, my own 2 cents is you're a hell of a lot closer to it rolling back over than continuing higher.
I don't dispute that. That's why we have a lot of cash.
Yeah.
We've continued to hold on to our inverse ETF positions in the Pro portfolio. I will say that in addition to those companies, right, I think what they say about capital spending will be very important. With Microsoft, I think you're going to have to understand, how much is through OpenAI, how much is through CoreWeave, right? But when you amass it all together, right, the company that you have to be concerned about is going to be NVIDIA.
100%. And when you look at Microsoft, they've been walking back their AI CapEx for a while. Yeah, I want to see what they say formally on their call. I don't expect it to be terribly bullish for NVIDIA. You can look at NVIDIA and say, based on their numbers and PE, sure, it can be fine. But it's impossible. Everybody's looking at NVIDIA that's been in trading for a while and saying, is it Cisco? Is this back to the infrastructure play of Cisco in the late 90s, early 2000s? AI is going to be huge, 100%, just like the internet was huge. But eventually the price of that infrastructure came down dramatically. Yeah. It kept building out, but the prices came down. Is it going to be the same thing for the chips? Was DeepSeek, did that show us the path out that the prices are going to come down?
I don't think there's any question that prices are going to come down. I think when we step back and we look at the accelerating AI adoption, that just tells us that we're going to need incremental capacity over time.
Yes.
Right? And there's 2 parts to that, right? There's the data center side, and then there's the network side, mm-hmm. right? Because when you think about how we use AI, it creates and consumes a tremendous amount of data, right? That is going to congest the networks. And candidly, that's why in the portfolio, we're long not only NVIDIA, but we're long Marvell as well for that communications infrastructure business.
So you beat me to it, because I was going to say, if you're really interested in being in that chip related to AI or something to that effect, Marvell, Broadcom. I would lean toward those. Marvell I like for one simple reason. I'm not going to guess at who might do it, but it's a heck of a lot easier for another company to swallow up Marvell, which gives it another reason to own it.
Interesting. All right, Bob Byrne, thank you so much for joining us today. We will have you back because we're going to want to tap that Reg A market and other deals, as well as get some insight on what you're thinking as we kind of get more certainty in the market. Folks, we will be back with a new episode before you know it. Thanks for tuning in to this episode of The Street's Stocks and Markets podcast.